Ladies and gentlemen, how are you tonight? How are you tonight? Are you able to hear me? Great. So I can see one student who is saying fine, which is okay, and that is a student who has been able to label himself or herself very well. Very well. That is how you sign in to WhatsApp. Yeah, you write your full names. Don't come in here with a make of your mobile phone number. No. Now, ladies and gentlemen, today I would want us to have a recap on this valuation concept. Remember the concept that you're looking at, the topic that you're looking at is valuation. So I would want all of us, if we have access to our past papers, let's go to December 2013, question number 5C. 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 Thank you very much, Abby. Thank you very much, Catherine. So December 2013, question number 5C, valuation of ordinary shares. Valuation of ordinary shares. We have also tackled valuation of bonds. So before I go to valuation of preference shares, let's first of all recap. So we have question 5C, December 2013. Is there somebody who has that question? Is there somebody who has been able to get that question? December 2013, question number 5C. Do we have that question, my great friends? Yes. Catherine says yes. How about the others? The others today, they seem... Imelda Nziza says no. What I would recommend is if you guys could take a snapshot of the question that you have and then you send that question to our WhatsApp group. I will really be very happy. I will be very happy if you great students of mine, could take just a photo of that question and send it straight away to us through our WhatsApp group. December 2013, question number 5C, they gave us a question, nice question there. Maxi Enterprises Limited. Oh, for those of you who have this book, for those of you who have got this book, it's page number 49. Page number 49. For those of you who have purchased the RCM's revision kits, page number 49, Maxi Enterprises Limited had the following pattern of earnings per share over the last 5 years. So over the last 5 years, what do we have here over the last 5 years? So over the last 5 years, ladies and gentlemen, we have 2008, we have 2009, we have 2010, we have 2011, we have 2012. And then, ladies and gentlemen, these people have been able to give me the earnings per what? Earnings per share. They have given us earnings per share, EPS. Like 08 we have 4, 09 we have 4.2, 2010 we have 4.41, 2011 we have 4.63, 2012 we have 4.86 like that. 4.86 like that. And then, ladies and gentlemen, they have given us the company maintained a constant dividend payout ratio of 40%. 40%. So we have dividend payout ratio 40%. So we have dividend payout ratio, dividend payout ratio is 40%. It's 40%. Now, ladies and gentlemen, who can give us the formula of getting dividend payout ratio? Kindly remind us. Which question? It's quite here. We have December. The question is December. The question is December 2013. December 2013. Question number 5C. 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 So they have given us dividend payout ratio, of which I expect a good student to give us the formula of dividend payout ratio. Could you kindly give us this formula of dividend payout ratio? I'm waiting for you guys to give me the formula. I'm waiting for you great people to give us the formula. Babino, welcome to give us the formula. I'm waiting for you to give us the formula of dividend payout ratio. Formula of dividend payout ratio. I'm waiting. I know you guys know. Dividends paid out. Dividends are normally paid out of their earnings. Out of our earnings, I mean. So meaning that dividend payout ratio is always DPS, is always dividends per share, all over earnings per share. To get a dividend payout ratio, you'll always be taking dividends per share all over earnings per share. Please write this, and if possible, I would want you to block this. I would want you to highlight this. Dividend payout ratio equals dividends per share all over what year? EPS. All over EPS. And then I would want you great people of mine to make DPS the subject. You make DPS the subject. You make dividends per share the subject of the formula. You make dividends per share the subject of the formula. Make dividends per share the subject of the formula. Make dividends per share the subject. If I do that, if I cross multiply, I will be able to see right away that my dividends per share will be equal to dividends payout ratio times EPS. Dividend payout ratio times EPS. If I make this DPS the subject, if I cross multiply, my DPS will be equal to dividend payout ratio times EPS. So then this will translate to 40% of our EPS. 40% of our EPS. 40% of our EPS. So then I would want you great students of mine, kindly give me the DPS for each of these years. Give me the dividends per share for each of those years. Give me dividends per share for each of the years. Give me dividends per share for each of the years. For each of the years. Gentlemen, simama mkapunge mnamo. So anytime you see this examiner giving you dividend payout ratio, he wants you to compute the dividend per share. He wants you to compute the dividend per share. So could you kindly give us 0.4 times 4? Someone talk to me tonight. This is 0.4 because they have told us that the dividend payout ratio, they have told us in this question, the dividend payout ratio is 40%. So kindly help me out. AB tells me 1.6. 0.4 times 4 is 1.6. How about 0.4 times 4.2 so that I can be able to get the dividend per share for the year 09? For the year 09, I can see 1.68. Thank you very much. 1.68. How about 0.4? You know, 0.4 is constant. 0.4 is constant for each of these years. So 0.4 times 4.41. 0.4 times 4.41. What figure are we able to get as a dividend? Which was 1.764. Thank you very much. 1.764. And then we have dividends for the year 2011. Dividends for the year 2011. Dividends for the year 2011. I can see somebody giving me a figure of 1.852. Aisha, now I remember your name very well. 1.852 for 2011. For 2011. How about in this case here for the last year, which is 2012? 2012, I'm being told by Imelda, it is 1.9, by Sunaya, 1.944 like that. 1.944 like that. Ladies and gentlemen, once you see this examiner giving you many dividends like that, when you see this examiner giving you a multiple of dividends like that, what do you think are we supposed to do? Whenever you see many dividends, what are we supposed to do? In finance, if you see dividend 1, dividend 2, dividend 3, dividend 4, what are we supposed to do, ladies and gentlemen, in that case? What are we supposed to do in that case whenever we see many dividends? Whenever we see many dividends, what are we supposed to do? I'm waiting to hear from you, my great students. Waiting to hear from you, my great students, when you see many dividends. Very good. We have already called Catherine. As a finance manager, anytime I see many dividends like that, anytime I see many dividends being given like that, the very first thing that I would want to know as a finance manager is how are these dividends growing? Because dividend growth is one of the major functions of a serious finance manager. So anytime you see wanaambia wanafunzi wangu hizi dividends sio flower, sio maua, tunaangalia tu tuseme ukiona dividends zimepeanwa mingi, always come and give us the growth rate. Thank you very much, Catherine. So but what will be the formula for getting this growth rate of dividends? What will be the formula for getting the growth rate of the dividends? Even Brian Musioka had also thought of the same. That's very good. Brian Musioka, I know Brian Musioka very well. So, but now, please let us go a step further and give Mwalimu the formula of getting this growth rate. The formula of getting the 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 growth rate. I'm waiting to hear from you. Don't fear anything. You simply write something. And of course, if you can't remember, you simply tell us, I can't remember. We cannot remember, or we have not even been taught. Very good. Catherine has given me a very important formula there. Retention ratio times cost of capital. This formula, which says that for you to get G, take B times R. Actually, R is not the cost of capital. R is not the cost of capital. R is what we call the return on assets. R is the return on assets. So that formula of BR, this formula where we talk of growth rate being equal to BR, this R is supposed to be ROA, return on assets. This person who discovered this model of getting growth rate, he told us something very interesting, something that can also help you as an individual to manage your own finances. That if, for example, you are getting, like, say, 100,000 every month, don't consume everything out of that 100,000. Don't consume everything out of this 100,000. Make sure that you retain. That is why we talk of this being the retention ratio. What are you able to retain? And when you retain, don't go and take that money and hide it somewhere in some room in your house. Then you will not grow. When you retain, you need to invest. you invest these assets, you invest your money here, they take the earnings in assets that are productive. So according to the person who discovered this, he said that for you to have a growth rate of your assets, always ensure that you have your retention ratio and then invest this money in assets that have what year returns. Thank you very much, Catherine. I never expected anybody in section 3 to have this formula in their mind. However, that is not the formula we shall use here today to get growth rate. Whenever you've got a number of dividends like that, to get growth rate, we normally talk of n-1 all over the current dividend per share, current DPS, all over the oldest DPS, and then whatever I will get, I will come and subtract 1 there. I'll come and subtract 1 there. So there are people who are waiting for us to have them in the meeting. I'm not seeing anybody in my waiting room. I'm not seeing anybody. I can see Infinix. But these people coming there with their phones, next time will not allow them. People need to know how to join a Zoom meeting because I need to know your names. I need to know your names. So this is a very important formula which we shall be using whenever we have got a multiplicity of dividends per share, So in this case here, N, remember N stands for number of years. So number of years, you count them, the number of years we have. How many do we have? 1, 2, 3, 4, 5. So our N is 5. So 5 minus 1, that gives us 4. So then this will be the fourth root of the current. The most current dividend is 1.944. The most current dividend is 1.944 all over the oldest dividend, which is 1.6. The oldest dividend, which is 1.6. And then at the end of the day, ladies and gentlemen, I will come and subtract what there? I'll come and subtract 1. So then if I'm the one doing this, first of all, I'll get this quotient. I will punch there 1.944 divided by 1.6. And then whatever I will get, I will come straight away and find its fourth root. So the quotient here, I'll come and find its fourth root. The quotient here, I'll come and find its fourth root. Please come and find the fourth root of this quotient. I want to see whether there is anybody who will be able to get this correctly. So we have here fourth root of this quotient. So first of all, get the quotient. So we have 1.944 divided by 1.6. Once I get that answer, I'll come and say 4, and then I look for shift. This button called like this. I look for shift because I want its x root. So 4, shift, I press this, and then I'll be able to see the x root. Once I have the x root displayed, I'll write in this case here this, or I can even come and use brackets. So I can use brackets, 1.944 divided by 1.6, I close brackets, equals. Whatever I get, I say minus 1. Whatever I get, I'll come and say minus 1. So is there somebody, ladies and gentlemen, who has been able to give us that fourth root? I can see from Mapena. Mapena gives us 4.99. We have Sumaya Noor, 1.049, but Sumaya, you must have forgotten to subtract this one. This one is very important. You must have forgotten to subtract that one. We have Sunaya again repeating like 5%. That is still okay. So what the students are telling me is that whatever they have gotten, they have even gone a step further and multiplied with work 100 to get a growth rate of 4.9%, which is the same as 5%. Now, ladies and gentlemen, the moment I have that figure 5%, now I know I'm at home. They want us, if you read the requirement, they want us to give them the company's theoretical value of the share. The company's theoretical value of the share, value of the share. Now, ladies and gentlemen, if that is the case, theoretical value of a share, I will come and remember very fast how to get the value of a share. So to get value of a share, current value of a share, that is our PO. And ladies and gentlemen, our PO, provincial officer, will always be equal to district officer. District officer who has to grow. District officer who has to grow. So we have 1 plus G all over Kenya minus government. Kenya minus government, honestly, a country where the president and his deputy can't see eye to eye. Can we say we have a government? Can we say we have a government where the president and the deputy president can't see eye to eye? Can't see eye to eye. Very good. This is just something to enable you remember this formula of getting PO in the long term, even post you clearing your section 3. The students are normally meet in these SPAC seminars, and one of the many things they'll always remember is this formula, because I've used this formula for over 20 years. Provincial officer equals district officer into 1 plus G all over Kenya minus who? Government. Where PO is not provincial officer, in real finance terms, PO stands for what here? The current market price per share. Current. This is the same as value per share. DO is the current dividend per share. Then we have G is the growth rate. KE is cost of equity. Cost of equity, in the absence of the cost of equity, use cost of what here? Capital. Use the required rate of return. So, ladies and gentlemen, please come and substitute for us. Remember, the current dividend is not this oldest dividend. The current dividend is 1.944. So 1.944 into 1 plus the growth rate that you guys gave me, which is 0.05. All over the required return, I can see there is 13%. And 13% is the same as 0.13. 13% is the same as 0.13 minus the growth rate again, which is 0.05. So I want you to do me a favor, go slowly, get the numerator, get the denominator, and then you give us the quotient. You give us the quotient. The moment you do that, you'll have answered that question. The moment you do that, you will have answered that question. You'll have answered that question. So there are students who have even gone ahead of Mwalimu to get the answer. They're getting 25 point what here somebody? 0.52, that is correct. 25.52 is correct. Is correct. Thank you and thank you very much. Thank you and thank you very much. Now before, remember I'm trying just to recap. So before I go to my today's concept, I would want somebody to try that question that is below there. The question of December 2013, question number 2. Again, it's about intrinsic value of the ordinary share. December 2013, question number 2. We have here December 2013, question number 2. 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 For those of us who may not be having this question, the easiest thing is to have the ones who have the question, taking a photo of that question, and then they throw it in our WhatsApp group. And I'm giving you 5 minutes to attempt that question, because I strongly believe that it's a question that all of us have done. It's a question that all of us have done. So I'm giving you exactly 5 minutes to try the December 2013 question number 2B. Question number 2B. So we have a good student here who wants us to differentiate between earnings per share and the dividends per what year? Per share. So remember, how do you normally get earnings per share? I'll go to the profit statement. So the profit statement that I have, I'll pick on the profit after taxation. So the profit after tax is what I will distribute out to using the number of ordinary shares that I have. So to get earnings per share, I will take in this case here the total earnings divided by number of ordinary shares. How about DPS? How about dividends per share? So you see, ladies and gentlemen, normally if you have gotten a profit of 10 million, you can't dish out everything to the ordinary shareholders. You must retain something. So whatever that you will retain is what you will subtract from what you have earned here for you to be able to get the total dividends payable. So for us to get the dividends per share, you will come and give us the total dividends. You divide again by what is number of ordinary shares. Divided by number of ordinary shares. So when you are getting growth rate, listen to me very well. I've seen students who use earnings per share. We can only use earnings per share if the dividend payment ratio is the same. Like this question was 40% the same. But if the dividend payout ratio is different, then if you use EPS to get growth rate, you will be wrong. And that is why in all my classes, I normally tell all my students, regardless of the EPS as you are given, always calculate DPS for each year. To avoid confusion, calculate DPS for each year. So I hope, Brian, I've been able to answer you. Great. Thank you very much. Be blessed too. Thank you very much. So, ladies and gentlemen, let's do this question together. Can I give you more time to finish it, or I just do this question, the one that I've given you, December 2013? Do I add you some more minutes, or do we have most of us just there, not writing anything? So do I do the question, or I give you some 2-3 more minutes? Somebody talk to us, talk to us, talk to us. This December 2013, talk to us. Give us time, but not very many minutes, only 3 minutes, only 3 minutes. You're counting only 3 minutes, only 3 minutes, and then be able to see who will be able to get it right. So I can see students who are getting 45.267 like Brian, Prudence 45.3, Cynthia 45.3, Collins Muteti 45. That is quite excellent, quite excellent, quite excellent, quite excellent, quite excellent, quite excellent. Very good, very good. If that number, to go by that number, if I was to go by that number, then I should be able to conclude that everybody knows how to do that question. I should be able to conclude that everybody knows how to do that question, that Mwalimu don't even do that question for us. Don't do that question for us because all of us are just good in this. Is that the case, my great students? Is that the case, my great students? Yes, we have one student. Do it, please. Okay. So, and this is a common area, of course, I've shown you even from other past papers. It's a common area. Very common area in our exams. So we have the current. So they're telling us December 2013, December 2013, question number 2B. December 2013, question number 2B. Mongo Limited currently pays a dividend of shillings 4. So currently, so we have here time, current is 0 times 0. So the DPS, current DPS, ladies and gentlemen, they are telling us is 4. And then the dividend is expected to grow at 15% per annum for the first 3 years. So we have year 1, year 2, year 3. So and we are having this thing growing by 15% per annum. So I'll come and say year 1 to be 4 times 1.15. Where did I get 1.15 from? Because of the 1 plus the growth rate. Growth rate is 15%. So 1 plus 0.15 gives me 1.15. So ladies and gentlemen, if that is the case, I'll simply be patient and come and do the multiplication. So what do I have? Ladies and gentlemen, what I have with me here is quite simple. So I will talk over 4 times 1.15, which gives me 4.1 here, somebody? 4.6, which gives me 4.6. And then I go to year 2, I'll have this 4.6 growing again by the same percentage, because they told us 15% is for the first 3 years. 15% is for the first 3 years. So we have that 4.6 times 1.15 giving us 5.29. From there, again, this 5.29 must be multiplied with the 1.15. So we have here times 1.15, which will end up giving us 6.08. 6.08 perhaps 4. I don't have to write everything. I can decide that my maximum number of decimal places will be 4 or 3. So ladies and gentlemen, we go to the next thing. After these 3 years have lapsed, what have they told us next there? After the 3 years, ladies and gentlemen, have lapsed, what do we have there? After the 3 years have lapsed, ladies and gentlemen, we are told then at 10% per annum for the next 3 years. So the next 3 years will take me year 4, 5, and what year? 6. So I'll start having this growing by 10%. So then this will be 6.084 times 1.1. So whatever we have here, whatever we have there, I can better start again. So we have 6.084 times 1.1, which will give us 6.69. 6.692. So this 6.692 is what I bring here. 6.692 have the same growing by 10%. So times 1.1, which will give me 7.362, and then I have the same 7.362, ladies and gentlemen, growing by 10%. So times 1.1, which will end up giving us 8.09, 8.09, 8 like that. And then what happens after the 6th year? After the 6th year, ladies and gentlemen, I'm told after which the dividend will grow at 5% per annum to perpetuity. 5% per annum To perpetuity means we use the provincial officer. So meaning here in infinity, we are making use of the provincial officer. In infinity, we are making use of the provincial officer. Anytime you hear of an infinity, always remember our provincial officer, which is equal to district officer into 1 plus growth rate all over Kenya minus government. All over Kenya minus government. Therefore, our most current dividend that we have, ladies and gentlemen, is this one, which is 8.098 into 1 plus the perpetual growth rate. The perpetual growth rate that this examiner has given us is 0.08, 0.05, sorry. It's 5%, 0.05 all over the cost of equity. In the case that the cost of equity is not given there, always use what your cost of capital. But here they gave us expressly the cost of equity. They told us the required rate of return for the ordinary share is 18%. For the ordinary share is 18%. Is 18%. So 18%, this is what I'll be using as my cost of equity. So this is 0.18 minus the growth rate, which again is 0.05. So could you kindly give me this figure? Somebody go slowly and they give me the perpetual. Anytime you hear of perpetual growth rate, always remember the PO concept. Remember the PO concept. Remember the PO concept. So this is infinite, the infinite cash flow. This is how we get the infinite cash flow. So please go slowly there. Tell us 8.098 times 1.05. You write that answer separately. Write that answer separately. And then you have 0.18 minus 0.05. Write that answer separately. And then now you give us the quotient. When you give us the quotient, what are we going to get, my brothers, my sisters? When you give us that quotient, what are we going to get at the end of the day, my friends? Please help me out. I want to see whether there is somebody who will be able to do this nicely. 8.098 times 1.05, store that figure somewhere, divided by 0.18 minus 0.05, store that figure somewhere, give us an answer. So we are able to get 65.41. I can see students getting 65.41, and if you allow me, I'll come and delete this right here, 65.41. 65.41. Now, ladies and gentlemen, after that, now we want to get the value of this share. Remember, to get the value of a share, you normally look at the future cash flows. When I buy a share, I'll be getting these dividends in the future. And then what do? I discount them. Ladies and gentlemen, whenever you are getting share value, please, the current dividend can never be used, because the current dividend is historical. That has already been paid. We are thinking of the future. So the current dividend should always be eliminated. And that is why, actually, this provincial officer formula, we normally say it's DO into 1 plus G all over Kenya minus government. But if you come and look at this thing keenly, you realize most books saying DO times this 1 plus G should give us D1. D1 all over Kenya minus government. So whenever we are getting PO, always dividend-wise, we think about expected dividends. We think about the future, the expected dividends. We always think about the expected. So please, if you have to include this times 0 here, always ignore it when it comes to present valuation. Why? Because this money has already been paid. It has gone to someone's pocket, and we are valuing that shares using future dividends. So if that is agreeable, now come and discount what we have. So this is as good as if it was not there. So now come and create a column here where you will be able to give us what we call the present value interest factor at 18% at the firm's cost of capital, So before I start using the formula to ascertain my discounting factors at this 18%, I need to go to my tables. There are those tables that your examiners will always be giving you. So those tables, ladies and gentlemen, please read for us the PV. Read for us the PV. PV is present value, interest factor. See whether 18% is there. Don't work with the annuity table. There are normally two tables. There is one which is written expressly annuity. Go for the one that is on top, the one for irregular amounts. So 18% year one. Is there somebody who is able to read for us these figures very fast? 18% year one. What is the discounting factor? What is the PV? You look at 18% year one. Is there somebody who has those figures and should be able to read for us? Somebody who has those figures who should be able to read for us? Discounting rate, discounting factors. So the first one, I'm not yet getting anybody giving me any figure. I'm not yet getting anyone giving me any figure, my great students. I want you to give me the PV at 18%. Thank you very much. I can now see them coming in thick and fast. We have 0.8475. So the first one is 0.8475. How about the second one? The second one for the second year. Remember, you're looking at 18% column. 18% column. I can see 0.7182. Thank you very much. 0.7182. We continue the third one. The third one is point. Nobody has written the third one. There's no one who has written the third one. There's no one who has written the third one. There's no one who has written the third one. So the third one, what do we have there? The third one, for the third one, thank you very much, 0.6086. 0.6086, that's how it's supposed to be pronounced, but for making your life easier, we normally pronounce it in the African way, the better. The next one, I'm being told, is 0.5158. 0.5158. 0.5158. 0.5158. How about the fifth one? How about the fifth one? How about the fifth one? The fifth one. What do we have there for the fifth one? What do we have there for the fifth one? 0.7371, 0.4371. How about the sixth one? The sixth one, ladies and gentlemen, what do we have there? The sixth one, we have 0.3704, 0.3704. How about this infinity, which by the way has already been discounted from the future, but all the way up to the end of year 6? So the infinity has also to be given a present value interest factor, which is the same as this one. You simply take this one down for this arithmetic, you simply take this one down. And now, ladies and gentlemen, the moment you are there, come and give us a column here where you give us the present value. Give us a column there where you ascertain the present value. The present value. So how do we get the present values? We are taking these DPSs as our cash flows. DPSs as our cash flows. So you multiply with the PV for you to give us the present value, preferably into decimal places. Into decimal places. What do we have there? Somebody, 2 decimal places. 2 decimal places. Or 3 decimal places. 3 decimal places is fine. 3 decimal places is fine. 3 decimal places is fine. So the next one will be, the first one will be 3.896. 3.896. 3.896. I'm being given 3.896, 3 decimal places as the first present value. How about the second present value? The second present value, nobody has given me the second present value. Nobody has given me the second present value. The second present value. What figures do we have there? Somebody. The second present value. What figures do we have there? Somebody. So second present value. I'm being given 3.799, 3.799 here, 3.799. Let's go to the third present value. The third present value, Unfortunately, I'm only seeing the same names, and I don't want to leave anybody behind. Remember, even what has made me to recap this is because of the feedback that I got last week from you. Most of you are saying, well, we were very fast. And I really felt bad because the worst that I can ever do is to run ahead of you and leave you behind. No, that's not teaching. That's not teaching. That's not teaching at all. So I'm being given the next figure as 3.703, 3.703, 3.703. Thank you very much. Please give me all the others very fast so that I can get out of this particular question. So we have the next one as 3.452, 3.452, 3.452, 3.452, 3.452, 3.452. I'm still waiting for you great students of mine to give me some answers that I really want for us to be able to finish this question. So the next one, ladies and gentlemen, that we have there, the next one, ladies and gentlemen, that we have there, of course, I've been able to write 3.452. The next one that I have to write there is 3.22, 3.22. Thank you very much. 3.22. Please move on to the next one. 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 So the next one will be. Move on to the next one. The next one will be. Move on to the next one and tell us what the next one will be. These students would want some break, I think. They would want some break once you start realizing they're moving very slowly. So we have here 2.99, 2.998 or 3, 2.998 or 3, 2.998 or 3, or even 2.9999. And then the last one will be this 65.41 multiplied by that 0.3704. Multiplied by 0.3704, which will give us what figure, my great friends? My great friends, the last one will be 24.22 or 24.21, one and the same. Those are only of errors that are expected. So when you get this figure, then you will have gotten what we call the current market price per share. The current market price per share, or the intrinsic value. The intrinsic value of a share. The intrinsic value. The intrinsic value of a share. 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 Which I haven't seen anybody really giving me the answer. Which I haven't seen anybody giving me the answer. Giving me the answer. I'm waiting for that answer. I can see somebody giving me 45.30 or 45.28. I saw some students saying 45.28, 45.2. That I will give you a mark. Thank you. Thank you. Thank you. Thank you. Now, ladies and gentlemen, please allow us again to this 2013 sitting was a very good one. December 2013, you can see they even repeat this question severally. You'll get one sitting having these valuation questions in most cases, many of them. So December 2013, question number 1, boy. 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 So if you have that particular question, like I'm doing here, I will come right away, have a snapshot of this question, and then send it to my friends. Then I'll be able to send this to my friends very fast. So there's an element of some rights issue there. Yeah, Richie Limited intends to raise shillings 50 million to finance a new project through a rights issue. The project has a 10-year economic life with 0 scrap value. The project is expected to generate annual cash inflows of shillings 14 million annual, 14 million, and that is an annuity. The company has 10 million issued and a fully paid up ordinary shares. The market price of the company's ordinary shares before the announcement of the rights issue was 35 per share. The company's cost of capital is 14%. And then they want me to give them the price of the shares, but not your normal price, The price of the shares, what they are calling the CAM rights. So the person who will be buying these particular shares here will enjoy the right of the issue, which will be given in the near future. So this particular shareholding that you're buying today is coming with a right. Just like unaweza kununua ng'ombe, na hii ng'ombe ikuwe na mimba. Right? Ama ikuwe na ndama. Alafu huyu mwenye amenunua mpya ndiye anapata ile right ya kuenjoy maziwa. So this cow has come with a calf like that. So who can talk to us? So first of all, I would want you to write there as a dash. Ladies and gentlemen. Right there as a dash. That CAM rights into brackets. CAM rights into brackets. Or with rights, CAM is a Greek word for with rights. Coming along with the privileges with rights. Allows an existing shareholder to subscribe to a rights offering to a rights offering declared by a company, declared by a company, declared by a company for new shares bought, for new shares bought, for new shares bought, for new shares bought, for new shares bought. So the most important thing will be, how do we calculate the CAM rights price? How do we calculate the CAM rights price? That is quite a simple thing. To get the CAM rights price, ladies and gentlemen, to get the CAM rights price, we normally take the current market price per share plus, of course, when I invest my money, this money will be taken to some projects. And we expect these projects here to yield what we call NPV. So plus net present value per share. Quite interesting. If I were you, I would have written this and of course highlighted it. Highlighted this using some yellow highlighter. All the other highlighters are not effective. Yellow highlighter. You highlight this using a yellow highlighter. Using a yellow highlighter. If you don't have one, I can buy for you one because I know the essence of yellow. Yellow is a great color. So CAM rights price, it's supposed to be CAM rights price equals the current MPS plus NPV per share. So anytime you are asked by any examiner to ascertain the CAM rights price, even if you don't understand anything, look for cash flows given in the question and give us net present value as the first thing. So I want to see whether there is any student here who will be able to give us the net present value, who will be able to give us the net present value in this particular situation. So please give us the net present value and then we'll be able to compare notes. So what are you looking for? You're looking for net present value. Why? Because the examiner wants us to talk about CAM rights price. CAM rights price, I'll be having the privilege of receiving any net present value. I'm waiting for answers. My dear students. I'm waiting for that student who will be able to give me the NPV. I can see some students who have really given us nice formulas there, but I want you to go a step further. So great, I can see so many students saying that NPV is 23.03. Let's see, ladies and gentlemen, to get this net present value, I can see my examiner has given me an annuity. They have told me the project has 10 years economic life with zero scrap value, and then the project is expected to generate annual cash inflow of 14 million. So this 14 million, because it's an annual, I'll be getting 14, 14, 14. It has to be discounted, and I will discount this. We multiply this with what we call the PVFA. So PVFA, fortunately, they've given me the company's cost of capital, that is 14%. For how many years are you going to enjoy this over the project's useful life, which is 10 years? And then, of course, ladies and gentlemen, after I get the total present value, I must come and subtract the initial outlay, which is what here, somebody, which is 50 million. I must come and subtract the initial outlay, which is 50 million. So my work tonight will be to go to my annuity tables, go to a column that has got 14%, vis-a-vis 10 years. So go to my annuity table, go to a column written 14%. So 14%, 10 years. 14%, 10 years. If I do that, I will be able to get my PVFA. PVFA is present value, interest factor of an annuity. Present value, interest factor of an annuity. Ladies and gentlemen, if we have this, what figure are you? 2.3, 5.2161. We have here 5.2161 minus 50. And if I do that, I'll be able to get the total net present value. I will be able to get the total net present value. So in this particular case, my total net present value will end up giving us what figure? Please move with speed, move with speed, move with speed. So anytime you see this concept of come right, please always, please don't like that. So we are getting what figure? 23.03. 23.03. But now remember here, what do they want? They want us to give them the NPV per individual share. Remember, this project was to be invested, these funds were to be invested in a project with how many shares in total? How many shares? Wanasema the company has 10 million shares, fully whatever. So divide this by 10 million. So at the end of the day, it will be 2.303. And then you are at home and dry. So my come right price will be equal to the current MPS. The current MPS, ladies and gentlemen, what we have here for the current MPS, it is 2.303 plus NPV per share. NPV per share. No, current MPS is not this one. The current MPS has been given in the question. The current MPS has been given in the question. There is a place they told us in that line, the market price of the company's ordinary shares before is 35. So we have 35 plus 2.303, which will end up giving us what figure, ladies and gentlemen? Now, when you add the two, this will give us 37.303, and then you have your many marks for doing a lot of nothing. And that's why I like FM. FM is a paper that you should be able to score highly. So now I think in terms of valuation of ordinary shares, not unless you have got a question, I think now that one we need to say we are okay. Now from there, I would want us to go to just a small recap. Valuation of bonds or debentures. Remember, debentures are divided into two. We have the redeemable, and then we have irredeemable. Redeemable, and what here? Irredeemable. So for instance, let me just give you something here. So for instance, you'll be told a firm has issued a 10% debt instrument, to raise funds, full stop there. The bonds have a par value of shillings 200 each, and are currently selling at shillings 220. Shillings 220. Then they have given us the minimum rate of return. The minimum rate of return is 8%. So required, determine whether the bond is overvalued. So I'll give you exactly 1 minute. And then you advise us. Exactly 1 minute, and then you advise us. Now, ladies and gentlemen, sorry for that. So the first thing that I need to know is that here we are handling bonds which are infinite, bonds without any maturity period. If the maturity period has not been specified, then straight away we are handling bonds that are irredeemable. And if they're redeemable, two steps. Give us the interest amount. How do we get the interest amount? You take the coupon rate given. Coupon interest rate given is 10% multiplied by the par value. When you multiply this with the par value, you'll be able to get 20. But now remember that 20 will be coming to us indefinitely in the future. So I have to get the present value having that in mind, which will be 20 times 1 over r, which will be 20 over r. So 20 divided by 0.08 gives me what figure at the end of the day? 20 divided by 0.08 will give us what figure at the end of the day? Will give us what figure at the end of the day? Kindly help me. Kindly help me. I'm getting 250. I'm getting 250 from a good student there. Meaning that that is their truthful value. This is their truthful value. This is the amount that these particular shares should be trading at. So this is the intrinsic value. Given that I have the intrinsic value, the next thing, ladies and gentlemen, will be for us to say whether they are undervalued. What is happening? Currently, we are seeing these shares being sold for what, or rather these bonds being sold for 220. So we have the current share price, the current bond price is 220, which is less than their truthful value. Ladies and gentlemen, meaning that our bonds are what here? They are undervalued. Our bonds are undervalued. Our bonds are undervalued. Our bonds are undervalued. And if they're undervalued and you are a prudent investor will always think about what here? Buying undervalued assets. So you should buy. Anytime you hear that this asset is undervalued, like land is undervalued, buy. Like today, you want to buy securities which are really undervalued, go for Safaricom shares. Safaricom shares, as of today, they are trading at about 27. 27 is a gross understatement. The true value of Safaricom shares should be about 100 shillings. Remember, Safaricom as a company, with the kind of expansion strategies that they have, with the kind of diversification, it's a company that don't expect their revenue here to reduce, regardless of what happens. Remember, like there's a day when Raila Amolo Odinga came and told the followers that you guys resist Safaricom. I mean, people could resist for an hour or two. But at the time, what used to happen, people could still put on their Safaricom lines to see whether there are people who have sent them M-Pesa. They have diversified that much. Look at what is happening during COVID. During COVID-19, so many companies, weak companies are closing. But if you look at Safaricom's revenue, I'm so sure this year, Safaricom's revenues will go up by at least 30%. So their share value is an understatement. And that is why a good student, a good investor, remember nowadays, they're quite good. They only ask you to buy 100 shares minimum. Minimum is 100 shares. So if you get, for example, times 27, when you get 2,700 shillings, you can even decide to be buying Safaricom shares like 100 shillings every month. I know students, you guys have a lot of money. You have a lot of money. I know you can afford to skip your lunch. Don't skip every day. Skip like today, tomorrow you eat. Another day you skip like that. So you raise this amount of money, and every day you buy what here? Safaricom shares. At the end of, say, 10 years, you'll be very far. You'll come and realize that these shares, for example, will be made for 100 shillings. So you'll have made a capital gain of about 3 times. And by the time we'll be becoming as old as we are, you'll be having quite huge, significant shareholding at Safaricom. Very good. So anytime you get particular securities undervalued, always buy that. Always buy that. Now, ladies and gentlemen, please, without wasting much time, or rather, I can even give you an example, another example to try. So we have here illustration 2. illustration 2, they have given us a firm has issued a 10% bond, which is redeemable, in 6 years' time. In 6 years' time. Its par value is 1,000, and the cost of capital is 20%. So we are required to determine the value of the bond. Determine the value of the bond. So somebody saying that they can't hear me clearly. Mwingine anasema unakwama mwalimu. Are there students who are able to hear me clearly? We can't hear you. Okay, there must be a problem on my side. Must be a network problem. Can't see and hear you clearly. Same this end. Let's give it like 5 minutes. Let's give it like 5 minutes and then we continue. Ile kitu kimekula power. Naweza ukistop kweli. Ile vipi? Kimekula power. Ndio naweza stop. Stop. Okay, so are you able to see me now? Are you able to see me? Are you able to hear mwalimu? No. Right. They're not able to see. They're not able to hear. What is it saying? It must be network on my end. But unakatika katika ile. Or now you think we are okay? Okay now. Ah, great. Great, 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 great. So now here we are. We have a question. I hope now you can see this question. A farm has issued 10% bonds, a bond which is redeemable in 6 years' time. Its par value is 1,000. The cost of capital is 20%, and then you are required to determine the value. Remember, we are studying valuation of securities. Valuation of securities. So who can, I'm giving you 5 minutes. I'm giving you 5 minutes. Try. Can't see the board. Problems are many. Problems are many. But of course, we can't really work without problems. Problems are nice. So are you able to see the board now? Are you able to see the board or nothing really? Thank you. Great. So determine the value of the bond. I'm giving you 5 minutes. Determine the value of the bond. I'm giving you exactly 5 minutes. So what figure are we able to get, my friends? Yeah, par value is 1,000. Par value can be given anything. Like for bonds, mostly bonds, par value is 1,000. Par value is 1,000. So I can see, ladies and gentlemen, most of us getting 667.45. 667.45, 667.45. .45. It's quite easy. What these students have done, because it's redeemable, they have been able to know straight away that you have got two types of cash flows. There are two types of cash flows here. Here we have two types of cash flows. We have two types of cash flows. Which cash flows are these? We have number one, the interest amount. So interest amount, what do we have? It is 10% of the par value, which is 1,000, which is 100 per annum. Receivable for how many years? For 6 years. And we are saying that this is an annuity. This is an annuity. So it means that for purposes of valuation, I'll discount this using PBFA. And then, of course, ladies and gentlemen, there is another lump sum amount, which is the redemption value. Redemption value will receive this at par. So come here, right away, give us the value of the bond. So how do we get value of the bond? You will take the interest amount discounted by multiplying this with the PBFA, 6 years, 20% cost of capital, plus the redemption amount, where the redemption amount happens to be the par value. We assume that this bond will be redeemed at par. So 100 is a redemption, 1,000 I mean, is a redemption amount. So this 1,000 will only be multiplied by PV. Same percentages, 6 years, 20%. 6 years, 20%. 6 years, 20%. 6 years, 20%. So if that is the case, ladies and gentlemen, then we'll have here the interest amount you've given me, 100 shillings. So please go to your annuity tables and read for us. PVFA, 20%, 6 years. What are we able to see somebody there? Annuity tables, where you are able to see PVFA, 20%, 6 years. 20%, 6 years. So Catherine, we allow her back to class, but I cannot see her anywhere in the waiting room. She has not perhaps managed to come to the waiting room. So Teresa, it's good to see you, Teresa, again. I think now I've gotten to know your name. Teresia is 3.3255. 3.3255 plus the redemption value, which is 1,000 times PV. PV, please go to your tables where you have 20% present value interest factor, PV. PV, 20% present value interest factor for 6 years. What do we have there, somebody? For 6 years, what do we have there, somebody? 0.3349. 0.3349. And at the end of the day, ladies and gentlemen, what will I end up getting at the end of the day? What will I end up getting as the value of the bond on the basis of the cash flows receivable? On the basis of the cash flows receivable, what is the value of the bond? So, and I can't introduce really anything new at this particular time, but I would expect you great students to hit my YouTube account. Go to my YouTube account. My YouTube account is Joshua Aura. Joshua Aura. Please ensure that you subscribe. Ensure that you subscribe and look for so many videos which are there of financial management and what's the end. And if possible, promote your mwalimu by sharing those videos. Perhaps you could pick a video and share it on Facebook, on WhatsApp. Once you do like that, you will really be promoting your mwalimu, because your mwalimu would want to become the #1 e-learning provider in Kenya. #1 e-learning provider in Kenya. So please promote me. I'll be here for you to ensure that you meet your personal, professional, career objectives, which of course is clearing this, becoming a member of this pack. So there is no question currently at the moment, ladies and gentlemen. Please allow mwalimu to run away. It's been a pleasure hosting you. Good night. And I hope you enjoyed the lesson. I hope you never wasted your money.